Okay, so let's kickstart our session. Right, so just a quick introduction of myself, right? I'm Lee Sing. You can also find me on LinkedIn. So if you have any questions with regards to the session today, right? And if you're watching a recording of this, please feel free to reach out to me on LinkedIn. So just a quick disclaimer, the information presented here is not to be treated as investment advice. It's for educational purposes only. So this is the agenda that we will be covering for today. We will first take a look at MACD, right? So we've been covering this for the month, right? So essentially we'll do a quick recap on what MACD does, how we can use it as an indicator. And following that, we will take a look at how we can combine MACD with moving averages as well as stochastics. So those will be the two indicators that we will be taking a deep dive into for today, right? We will also cover a bit more on MACD convergence and divergence and how that ties in with market structure. And then finally, we will summarize the benefits of MACD and how we can use them in our developing our strategies. Okay, so just a quick recap on MACD, right, and what it does. So MACD is short for moving average, convergence, and divergence, right? There are three components to this indicator. So this is one that is frequently used by traders, right, in order to take a look at the market, identifying market trend, right? So MACD itself is a trend following indicator. It's suited more in trending markets. So there are three components to MACD. One is the MACD line. So the MACD line, as what we see at the bottom, right? This is the one in blue. So this is our MACD line. So essentially what this does here, the MACD line, it's that it's calculated using the difference between our 12 days and 26 days exponential moving average. So you can see that when the MACD line, right, so we have one, the blue line is the MACD line, and then we have the signal line. So signal line is the one in orange. The signal line is the 9 days. So the 9 days exponential moving average of the MACD line. So you can think of the signal line, right, as one that it's a lagging indicator, right? Or rather it's lagging because of the 9-day CMA applied to it. So if MACD line crosses below the signal line, this is a bearish signal, right? Similar to the concept of moving average crossovers. If MACD line crosses above the signal line, it's a bullish signal, right? So that's one thing to consider. The other thing to consider is to look at MACD, whether it's in a positive territory or negative territory, right? So this is taking a look at the histogram, right? So you can see that when MACD, so histogram basically measures the distance between the MACD line and the signal line. So you can tell that when the MACD line it's below the signal line, that's when your histogram is below 0. When your MACD line is above the signal line, your histogram it's above 0, right? Because MACD line it's higher than the signal line. And the gap between both of them, right? If you take a look at the gap between MACD and signal, you can see that as the gap widens, that's when your histogram, the magnitude of the histogram, right, the value would increase. So if the MACD line, it's much lower than the signal line, then you can see that the histogram will be more negative. If your MACD line is a lot more positive than the signal line, then that's when your histogram it's more positive. Okay, so those are the things to watch for MACD, right? In terms of how we can use it, right? The simplest one will be looking at a crossover when MACD crosses above 0. So if it stays in a positive territory, and when MACD is above the signal line, then this itself is a bullish signal, potentially, right? And when MACD crosses below, if it's below 0 and it also holds below the signal line, then this is a bearish signal. Of course, we don't want to just trade this in isolation, right? Because of how MACD is like, we want to ensure that it is also combined with what we are looking at it on a higher time frame. So it's important to recognize that, because if your higher time frame is bearish, prices are in a bearish market structure. MACD itself could be showing bullish, but this bullish just corresponds to a pullback into a resistance area before a deeper drop. Okay, so this is why when we take a look at MACD, we want to ensure that it also ties in nicely with our market structure, especially on the higher time frames. Okay, so let's take a look at our next slide. Right, so looking at MACD with other indicators. So in our previous sessions, we cover more on MACD divergence, what it does, right? But in this session, we are covering not just on MACD, but also looking at MACD combined with other indicators. And this example will be on stochastics. So stochastics itself, it's an oscillator, right? So helps to identify overbought and oversold region. So maybe just a quick recap on stochastics, right? So what stochastic does is that it has a range between 0 to 100, and essentially the one that is above 80, right? This is what is commonly termed the overbought region. So when price enters and exits that region, right, just in theory, when prices are overbought, right, we don't have enough buyers to push price higher. In this case, when momentum is starting to slow, then on stochastics itself, it shows that there is a potential when stochastics exit this overbought signal, right, there's a potential reversal in price. So if you take a look at times where stochastic did exit the signal, right? So stochastic exited the overbought region. We saw this, right? This itself is when price is somewhere here. You can see that stochastic pushed slightly higher before it pushed much. It continued to the downside. And this is in line with the entire structure, right? So if we talk about market structure, currently prices are in a downtrend, at least this portion of the chart. Why? Because if we take a look at the structure, we have a new low that's being formed, price continued, form an equal high, broke below the low, you can see a break in structure here. So once there's this break in structure that we're seeing here, a break below the last low, it shows us that there's a potential trend shift, right? Away from this uptrend, right now prices are changing direction and we're seeing a potential downtrend. And then this is further confirmed with a clearer break in structure that happens after, right? You can see price coming in, broke below the last low, which is this low form here, did a pullback. And then on stochastics, when price exited this region, right, this ties in nicely with our stochastics exiting the overbought region, right? So in our previous sessions, we did highlight the use of looking at market structure to determine which part of stochastics you want to focus on. If markets are in a downtrend, you can see that when stochastic exit this overbought region, right, then this generates a clearer signal for us. But in a downtrend, right, likewise, the converse is true. So if you're looking at exit of the oversold region, which means that when price we're expecting price to potentially bounce from this area. You can see that in a downtrend, when price exits this oversold region, right? In this case, it corresponds nicely to a pullback, but there are some cases where you can see this zone, right? So if price exited the oversold region, it also crosses above zero, right? This bullish momentum, it's only temporary. You can see that price pulled back before it continued to the downside. So a few things to note, right? One, it's of course looking at the time frame that we're trading on, right? So if we're on the higher time frame, we want to take a look at the general direction of the trend and use that trend to help us focus on stochastics, right? So if prices are in a downtrend, we want to focus on price exiting the overbought region because that's when we could see a potential reversal. If prices are in an uptrend, forming higher lows and higher highs, like in this portion of the chart that we're seeing here, right? So we see prices trending higher in an uptrend. You can see that we will want to take a look at stochastics exiting the overbought region. You can see this region, sorry, oversold region, right? So when price exits the 30, so the oversold region is 30, right? So when price exits the 30 mark and it continues higher, and that ties in with a clear break in structure, which shows that there is more momentum to the upside, right? Then this would be in line with the general direction of the trend. You can see that when prices are in a strong uptrend, forming clear higher highs and higher lows, stochastics can be in the overbought region for prolonged periods of time, right? So in this case, you can see that we're seeing exit of the overbought region by theory, right? If you take a look at just stochastics, when price exited the overbought region, right, it means that we could see a further bearish move down, right? We could see price pushing lower, but this is not the case in an uptrend. You can see that any exit of the overbought region in a clear uptrend where prices are forming bullish market structure, clear higher lows and higher highs. Any exit of this region, right, it just ties in nicely with a slight pullback before price continues to the upside. So in an uptrend, we want to focus on stochastics exiting the oversold region because this is when it's in line with the higher time, the trend's direction. Okay, so that's one thing to note, right? So just looking at stochastics alone, apart from just stochastics, right, we have our MACD. So in this example, you can see that when price starts showing a break in structure, so you can see clear lower lows and lower highs being established, right? You have bearish market structure being formed. Apart from just this break in structure and an exit of stochastics, right? You can see stochastics exiting the overbought region, right? So this is another sign that it's in line or ties in nicely with our downtrend. That's one, right? And if you notice on this side, we can see that stochastics is also showing us a bearish divergence, right? So bearish divergence happens when price starts forming higher highs, but at the same time, your stochastics is starting to form lower highs, right? So this is an indication of a potential shift in momentum, right? Which means that even though prices are climbing higher, but momentum is slowing. So when we observe this, right, and this bearish divergence ties in nicely with the break-in structure or the bearish market structure that we're seeing, which is basically lower lows and lower highs, right? Apart from that, we have a bearish divergence, we have an exit of the overbought region. Then this is a clearer indication that we are indeed seeing a reversal, especially because the break-in structure happened here, right? So if there is a break-in structure that happened here, and we're seeing that bearish divergence, along with MACD showing a bearish signal, right? So recall MACD, it's a trend or momentum indicator. So if MACD it's crossing into the negative territory and your signal line, it's now above the MACD line, right? So which means that MACD now crosses below the signal line. So when MACD is below the signal line, then this also supports the bearish bias, right? So if MACD is pointing to negative momentum or bearish move to the downside, and stochastics is starting to show signs of reversal with a bearish momentum, then what this shows us over here is that we are seeing a potential reversal in price, right? Are we going to be taking immediate shots from here, right? No, because we wouldn't know if price will continue higher, right? Even though there are signs of divergence, but as you can see in earlier examples, right? When when there are divergence in price, right, it might not necessarily point to a reversal. Sometimes price could continue much higher. So in this case, right, if we do see a divergence and an exit of the overbought region, right, and MACD is also pointing to the negative territory, a potential reversal, what we want to look at it here, right, just based on price action, it's to wait for clear range for price to trade within a clear direction and a break below that range, right? So this is the example. You can see that if I were to just clear this drawings, we have a range that prices were trading within before it broke below, right? So this is the range. You can just draw a horizontal line across, right? Essentially this box or this support resistance level that price seems to respect. Right, so if you take a look at it again, right, if I were to just draw a horizontal line across, you can see this range that we have here, price coming in to test the resistance, and then price coming in to test the support before it breaks below the zone. So that's one. Right? And if you take a look at the support zone here, you can see that this area, right, if price, once price breaks below this range, so this boxed up area that we have, right? Once price breaks below this range, we tested this region as a resistance. Right, what happens after is that you can see price and came back in to test this zone before it continues to the downside. Okay, so that's how we can use stochastics combined with MACD, right? And also more importantly, looking at market structure, right? So when market structure is showing a change in trend or bearish move to the downside, right? And this combined with MACD and stochastics will then give us a clearer sign. Okay, so let's take a look at another example, right? So the other example that we have would be on looking at MACD and moving averages. So MACD itself is a momentum indicator, right? And moving average, it's also a trend following indicator. So moving average itself, right? Essentially, there are different types of moving average, right? We have the WMA, EMA, SMA, right? So SMA just means simple moving average. So it takes the equal weight, it takes equal weightage for the past X number of periods, right? So let's say if you have a 20 days moving average, then it will take the past 20 days of close price and it will give the average. And if you take EMA, right, EMA is exponential moving average. It gives weight to more recent prices, right? So personally, I prefer using the exponential moving average, but I don't think there's too big of a difference, right? So how we can use this moving average, right? As you can see, moving average acts as a dynamic support and resistance level. So if price crosses below the moving average, right, it generates a bearish signal in theory. If price crosses above the moving average, right, it's a bullish signal. Right, so we could indicate there's room for more upside, but all of this, right, again, we don't want to take it just taking this signals in isolation, right? So in this case, if we have this move, as you can see here, right, this is the picture on the daily time frame. So daily or higher time frames are generally more reliable because higher time frames, you can see that the candles or the movement, it's a lot less choppy as compared to, let's say, on the lower time frames where we have a lot of fake outs or a lot of price coming in to wick the high, right, or sweep the high before it continues in the opposite direction. So in this example, you can see that this is the picture on euro dollar on the daily time frame. You can see again, right, prior to this whole move, we have prices forming lower lows, lower highs, and this is a clear sign of a downtrend, right? And then what happens after is that instead of the downtrend continuing from here, right, we saw that prices starts consolidating at this area, and a new high is being formed, but the high itself did not break the previous low. Rather, what happened after is that the high is then broken, price broke above the high, did a pullback into the demand zone, right? And this demand zone can be seen from the doji here, right? So previously I highlighted price coming in to test dojis, and dojis are nothing but ranges on the lower time frame. So if you look at this doji, for example, if you switch to the 4 hours time frame or the 1 hour time frame, you can see that this is an area where price consolidated multiple times before we saw a break to the upside. So this range on the lower time frame would then serve as a potential demand zone for price to revisit, right, before it continues higher. So with that in mind, you can see that when I extend this line across, right, this doji served as the demand area, price came in, tapped into this area here, and then it pushed up much higher. And this then serves as the next demand area. So for to extend this again, you can see that price came into the demand zone and again continued to the upside. And we see this bullish trend form, right? So when price starts showing this in terms of a break in structure, this is when we can look to indicators, right? Looking at our MACD. So MACD, it's a momentum indicator, right? So we want MACD to go into the positive territory. We also need to see MACD cross above the signal line to generate bullish signal here, right? So that's one, right? So when we see this strong move in price, so price, this bullish candle that we have here, right, that has hardly any wicks. So what this suggests is strong buying pressure, right, and enough momentum in order to sustain price such that your close price and the high price that we're seeing here, right, the close price and the highest price that we're seeing, they are relatively the same, right? So it shows that there's enough buying pressure to sustain this move up. And what happens here is that you can see MACD also crosses above 0. It's also in the positive territory. Right, so how we can use moving average in this case, given that moving average is a trend following indicator. And this example is probably not the best because this moving average, right, it has been tested, or we are seeing multiple fake outs, price wicking slightly above it before it continues to the downside. So what we want to look at for moving average, right, is not so much of just price coming in to test the moving average as a support or resistance level, but rather to identify that change in structure first. And once MACD starts showing this bullish signal over here, right, we can use moving average, right, price pulling back to the moving average as potential for entries and keeping the stop losses just slightly below structure, right? So if this is the last low that was being formed that caused that break in structure, then we know that for the uptrend, right, so let me just clear the drawing. So if this is the last low that was being formed and it broke above the previous high, then we know that when price pulls back, right, any pullback into this moving average, which then acts as a dynamic support, or a pullback deeper into this demand area here, right, it's fine. But if we are wrong on the setup, right, then when price breaks below this low, this is when we know that we are wrong on the setup. We want to get out of the position, because if it breaks below the low, then it shows that this uptrend could just be a pullback within the higher time frame before we see a further move down, right? So a lot of this, not just looking at moving averages, but also more importantly, combining your market structures. And once we have established that, right, so if there is a bullish trend that has been formed, right, then this moving average themselves can be potential entries, right? So moving averages, price pulling back to test it as a dynamic support, right? Of course, along the way, we could see potential break as well, right? So this fake out, but again, right, for this to generate a bearish signal, there must be a clear sign of a break in structure first. So in this example, you can see there's a clear sign of a break in structure here, and price broke higher. And even the subsequent ones, right, when price did a pullback, it broke above the last high, which is this high here, and then did a pullback on this wick before it continues to the upside. So there are two tracks that we can look at here, right? One is apart from just that trend shift. So once there is the change in market structure or the shift in trend, the next thing that we want to look at would be looking at price crossing above the moving average, right? So if price crosses above the moving average, then this is a bullish signal. If price crosses above, I mean, if MACD crosses above 0, and if it crosses above into the positive territory, right, then this itself, it's a bullish signal as well. Okay, so that's for looking at MACD with moving averages. So the next one that we want to cover would be looking at MACD and bullish bearish divergence, right? So maybe just a quick recap on divergence, right? Of course, this would also cover market structure. So on divergence itself, we have bullish and bearish divergence, right? So bullish divergence is formed when price starts forming a new low, but MACD starts forming a higher low. So in this example, you can see here, right? Bullish divergence is when price pushed lower, but for MACD it starts forming a new high, a new low, right? So this is an example of a bullish divergence. So again, for bullish divergence, we want to ensure that it's not just, we're not just taking the signals in isolation. And this is important because if we take a look at price, right, in a downtrend, you can see that price will start forming lower lows and lower highs, right? So if you take a look at this power move, right, we have a bearish market structure, price forming lower lows, lower highs on the way down here. Right, so when price forms lower low, lower high, you can see that a bullish divergence will happen when price forms a new low. But on MACD, right, it starts forming a new high, a higher low, right? So this example, right, let's say if we have price coming in to form a new low here, this example here, right? So let's say this point, right? So from this point, you can see that we have MACD at a certain point here. And let me just clear the rest of the drawing, right? So let's say from this point onwards, you can see that MACD or price forms a low. MACD has a value, right? And then along the way down, right, you can see price starts forming lower lows, right? But MACD starts forming higher lows. In this case, right, this can also be a bullish divergence, right? Because prices are trending lower, but MACD is forming higher lows. But in this example, right, why it would not make it a valid signal, it's because if you take a look at the structure, right, market structure alone, right, there are no signs of reversal. Prices are just forming your lower lows, lower highs, pushing to the downside, right? And this is the last high that was being formed that broke structure. You can see the high that broke structure, which means that as long as price holds below this whole leg, right, as long as it holds below the leg of this whole move itself, any pullback into the zone, we could still see room for more downside, right? Price could continue pushing into this resistance area before it continues to the downside. So what's important to note with this is that when price breaks structure, which is the last high, right? This is an indication that there's an end to the downtrend that we're seeing, right? The parallel move that we're seeing here. And this is when we can start looking for a bullish divergence, because the bullish divergence would just mean a pullback within the higher time frames demand, right? Pullback into potential demand zone. And this bullish divergence would then make sense because prices are already in an uptrend, right? So in an uptrend, if you're seeing a bullish divergence, right, it's continuation of the trend. So this is why this would be more valid as compared to looking at just bullish divergence in a bearish market structure. You can see this is an example of a bullish divergence, price trending lower and MACD trending higher. But in this example, right, where markets are still bearish, it's still showing lower lows, lower highs. There are no changes in market structure. In this example, right, this wouldn't be the best case, simply because the market, our price action itself is not showing any forms of reversal yet. Okay, and then we have a clear break above the high, the break in structure, price pulled back into the demand zone. You're seeing that bullish divergence here, prices forming new lows, and then stochastics forming, or rather MACD forming higher lows. And so this bullish divergence will tie in nicely with the break in structure or the bullish trend that we're seeing, right? And when price pulls back into the demand zone, right, again, we can wait for confirmation. So when price pulls back into a demand zone, we wouldn't know if this bullish divergence is going to hold, right? Because price could also continue lower. But you can see that following this, right, following this consolidation here, what we're seeing next is that price then broke above the most recent structure, right? Price broke and closed above the structure. Then you can see that price then pulled back into a demand zone here, right? So we have a resistance area that failed, price broke above structure, pulled back into the previous resistance area that failed, and now acts as a support. And MACD on this end, right, MACD it's also crossing above the positive territory, right? It's in the positive territory and it's also above your signal line. So MACD itself, it's also giving a bullish signal, and this ties in very nicely with your market structure because we have the first check here, which is that break-in structure, indicating that shift away, right, and potential end to the downtrend. And once price pulls back into a demand zone, this consolidation area here, we are seeing that bullish divergence. We are also seeing, right, apart from just the bullish divergence, we don't want to take immediate entries from here because price could just continue to the downside. So what happens after this bullish divergence was spotted is that price then continue to break structure. Okay, so in this case, right, this is the MACD. That ties in nicely with what we're seeing here. Okay, so I hope that this is clear so far, right? So in the next slide, we will have bearish divergence, right? So this example is slightly different from the previous one in the sense that you can see for bearish divergence, we are taking it purely based on a bullish market structure. Prices are still forming your higher lows, higher highs coming into this zone, right? And you can see that if price continues to the upside, right, it might do a slight pullback before it continues breaking structure. So even though we are seeing a bearish divergence here with a slight pullback, right, you can see that bearish divergence happen when MACD starts forming a lower high, but your price is continuing to the upside, right? And it forms a higher high. So this is an example of a bearish divergence. We're seeing that slight pullback into the demand zone here, right? Or into the previous low, targeting the previous low with a price sweep below the low. Right. So in this example, right, if we're seeing a bearish divergence in a bullish market, need to wait for other forms of confirmation. So for example, right, in this case, right, you can see that when price did a pullback into this move, right, this whole pullback leg itself, right, we can see on structure wise, right, price starts forming new lows and breaking below this region, right? So price breaking below the low, then this bearish divergence, right, would hold more weight, right, given that we have this, right? So if price starts forming higher low, when price starts forming higher highs and MACD starts forming lower highs, right? And then in this example, you can see that when price starts breaking structure, then this would then be aligned with the general move to the downside. Okay, so I hope that this is clear so far, right? If you have any questions, right, please just put it in the chat, right? So for today, we are covering on MACD. For tomorrow, we will be covering more on our live setup. So if you have any chat requests, right, do join us for that session. You will be able to just come in with your questions and we will be going through quite a few questions as well. I mean, quite a few chats. So if we have no other questions, right, then that's all we have for today, right? So thanks everyone. Right, so for tomorrow, if you want to sign up for the session, you can go to vantagemarkets.com/webinars. We'll have the session there. Right, so thanks everyone. Have a great trading week ahead and we will catch you guys again tomorrow.